Economic collapse does not begin with panic. It begins with imbalance. Not dramatic headlines. Not overnight bank failures. Not empty grocery shelves. Collapse begins quietly. With pressure. Pressure builds in credit markets. Pressure builds in household balance sheets. Pressure builds inside banks. Pressure builds inside governments. For years, everything can appear stable. Employment numbers hold. Stock markets rise. Corporate earnings expand. Consumers continue spending. Politicians speak confidently. Analysts debate soft landings. But underneath surface stability, leverage accumulates. Debt rises faster than income. Asset prices rise faster than productivity. Interest rates remain artificially suppressed. Liquidity masks fragility. Fragility hides in duration risk, in refinancing risk, in maturity mismatch, in dependency on cheap capital. Collapse is not a moment. It is a process. A slow tightening. Then a sudden break. Every collapse follows a pattern. First, excess expansion. Second, dependency on easy credit. Third, shock to liquidity. Fourth, forced deleveraging. Fifth, confidence fracture. And finally, system contraction. The shock that triggers collapse is rarely the root cause. The root cause is imbalance. The shock simply reveals it. In this episode, we are not predicting collapse. We are mapping the mechanism. Because once you understand the mechanism, you stop being surprised by the trigger. Economic systems are complex. But collapse mechanics are repetitive. Leverage expands during stability. Risk is underestimated. Debt compounds. Asset values inflate. Then something changes. Interest rates rise. Credit tightens. Liquidity dries. When liquidity dries, refinancing becomes difficult. When refinancing becomes difficult, defaults increase. When defaults increase, lenders tighten further. Tightening reduces investment. Reduced investment slows growth. Slowed growth increases stress. Stress triggers selling. Selling reduces asset values. Falling asset values reduce collateral. Reduced collateral increases margin pressure. Margin pressure forces more selling. The cycle accelerates. Collapse is not chaos. It is feedback loops. And feedback loops move faster than expectations. Today's global economy is larger, more interconnected, and more leveraged than at any time in history. Debt levels are elevated. Asset valuations are stretched. Governments are running persistent deficits. Central banks are balancing inflation control with financial stability. The system is resilient. But resilience depends on liquidity and confidence. Remove liquidity. Crack confidence. The mechanism activates. This is how the economy collapses. Not with noise, but with tightening. And tightening is already measurable. Now we break down the first stage. Excess expansion, the illusion of stability. Every collapse begins during a boom. Not during recession. Not during visible crisis. During optimism. Expansion feels sustainable. Growth appears structural. Asset prices climb steadily. Credit is abundant. Banks compete to lend. Investors chase yield. Companies refinance debt easily. Consumers borrow confidently. Governments expand spending. Low interest rates encourage leverage. Cheap capital changes behavior. Projects that would not make sense under higher rates suddenly appear profitable. Risk tolerance rises. Credit standards loosen. Duration risk increases. During expansion, leverage feels rational. Borrow to invest. Invest to grow. Grow to refinance. refinance to expand. This loop works as long as liquidity remains abundant. Asset prices become collateral. Collateral supports more borrowing. More borrowing supports asset purchases. Asset purchases push prices higher. Higher prices validate optimism. Optimism suppresses caution. Caution feels unnecessary. But leverage is cumulative. Debt compounds quietly. Governments roll over deficits. Corporations issue bonds. Households take mortgages. Financial institutions layer derivatives on top. None of this appears dangerous while cash flow remains stable. But expansion masks fragility. Why? Because leverage compresses margins for error. The more debt embedded in the system, the more sensitive it becomes to interest rate changes. The more duration risk taken, the more exposed balance sheets are to yield shifts. The more asset prices rise relative to income, the more dependent households become on price stability. Expansion stretches valuations. Valuations stretch confidence. Confidence stretches risk tolerance. Risk tolerance stretches leverage. Now consider refinancing risk. When debt matures, it must be rolled over. If interest rates are low, rollover is easy. If interest rates rise, rollover cost increases. Higher rollover cost reduces cash flow. Reduced cash flow increases default probability. Expansion often creates short-term borrowing structures to reduce cost. Short-term borrowing increases refinancing frequency. High refinancing frequency increases sensitivity to liquidity tightening. As long as liquidity flows, expansion continues. But expansion builds structural dependency on cheap funding. Dependency is invisible during good times. Invisible risks are the most dangerous. Consider commercial real estate. Low rates encourage borrowing. Borrowed funds increase property demand. Higher demand increases prices. Higher prices justify higher valuations. Valuations support larger loans. Larger loans increase exposure. If rental income remains stable and refinancing remains cheap, the system holds. But if occupancy declines and refinancing costs rise simultaneously, balance sheet strain. This is not collapse yet. This is vulnerability. Expansion builds interconnected vulnerability. Banks hold loans. Funds hold bonds. Insurance companies hold fixed income instruments. Pension funds rely on predictable yield. When interest rates rise after long suppression, valuation shifts cascade. Bond portfolios decline. Funding costs rise. Floating rate debt payments increase. Margin pressures build. Expansion conditions participants to expect stability. Stability encourages leverage. Leverage increases sensitivity. Sensitivity remains hidden until tightening begins. That is the illusion. During expansion, risk models rely on historical volatility. If volatility has been low for years, risk appears manageable. But volatility regimes shift. Regime shifts expose models. Models fail when assumptions break. The first stage of collapse is not contraction. It is recognition. Recognition that assumptions are changing. Interest rates no longer falling. Credit no longer unlimited. Liquidity no longer infinite. At first, markets deny it. Then they debate it. Then they adjust. Adjustment reduces asset prices. Reduced prices weaken collateral. Weakened collateral reduces lending capacity. Lending capacity contraction reduces economic activity. But this is gradual. The illusion of stability persists longer than fundamentals justify. Because incentives resist adjustment. Governments prefer growth narratives. Corporations prefer optimism. Investors prefer upward trends. Central banks prefer controlled normalization. But normalization tightens conditions. And when leverage is high, tightening multiplies effect. Expansion is not wrong. Growth is necessary. Credit is essential. But excess expansion without margin for error creates fragility. Fragility is not visible in calm water. It reveals itself when currents change. The first stage of collapse is overextension. Overextension feels productive. Until it does not. And once overextension meets tightening, the mechanism moves to phase 2. Liquidity stress. Liquidity tightening, when credit stops flowing. Expansion depends on liquidity. Liquidity is not just cash. It is the ability to refinance debt, to access credit, to roll over obligations, to borrow at predictable cost. When liquidity is abundant, even weak balance sheets survive. When liquidity tightens, weak balance sheets are exposed. Liquidity tightening rarely begins with panic. It begins with policy. Interest rates rise to fight inflation. Central banks reduce asset purchases. Bond yields climb. Funding costs increase. Banks become cautious. Credit standards tighten incrementally. At first, tightening appears healthy. Risk discipline returns. Speculative lending slows. Markets adjust modestly. But systems built on cheap money respond disproportionately. Consider floating rate debt. When policy rates rise, interest payments increase immediately. Corporations with variable rate loans see costs jump. Governments issuing short-term debt face higher rollover expenses. Households with adjustable mortgages feel pressure. Higher payments reduce discretionary spending. Reduced spending affects corporate revenue. Lower revenue weakens debt coverage ratios. Weakening ratios alarm lenders. Lenders tighten further. Credit is forward-looking. Banks anticipate risk. If they expect slowdown, they restrict lending preemptively. Restricted lending slows investment. Slower investment reduces job creation. Reduced job growth dampens income expansion. Income expansion slows consumption. Consumption decline pressures businesses. This is not collapse yet. This is contraction pressure. Liquidity tightening also affects asset markets. Higher yields make bonds more attractive relative to equities. Capital rotates. Equity prices soften. Softening equity reduces wealth effect. Reduced wealth effect lowers spending. Lower spending slows growth. Slower growth increases default probability. As defaults tick upward, lenders reassess portfolios. Reassessment tightens credit availability. The feedback loop accelerates. Now consider refinancing walls. Many corporations issued debt during low-rate periods. Maturities cluster. As those debts come due, refinancing requires higher interest rates. Higher interest rates increase annual expense. Increased expense reduces net income. Reduced net income pressures stock prices. Lower stock prices increase cost of equity financing. Capital access narrows. Liquidity tightens further. Small and medium businesses are particularly sensitive. They rely on bank credit more than capital markets. If banks tighten lending, these businesses struggle. Struggling businesses cut hiring, or reduce payroll, or close locations. Closures increase unemployment. Unemployment reduces aggregate income. Reduced income slows consumption. Consumption slowdown hits corporate revenue. The system feeds on itself. Liquidity tightening also exposes duration risk. Institutions holding long-term bonds purchased at low yields face valuation losses when yields rise. If those institutions must sell assets to raise liquidity, losses become realized. Realized losses erode capital. Eroded capital limits lending capacity. Limited lending capacity restricts credit. Credit restriction slows economic activity. Central banks may respond. They face a dilemma. Continue tightening to control inflation, or pause to protect financial stability. Policy uncertainty increases volatility. Volatility raises risk premiums. Higher risk premiums increase borrowing costs. Even without further rate hikes, financial conditions tighten. Financial conditions are broader than policy rates. They include credit spreads, market liquidity, risk appetite. When spreads widen, borrowing becomes expensive even if policy rates stabilize. Corporate bond yields rise relative to treasuries. High-yield markets freeze. New issuance slows. Companies dependent on market financing struggle. Struggling issuers reduce investment. Investment decline slows growth. The transition from expansion to tightening is the most delicate phase. If leverage is modest, the system absorbs tightening gradually. If leverage is elevated, tightening multiplies effect. Household debt, corporate debt, and sovereign debt now sit at historically high levels globally. High debt increases interest sensitivity. Even small rate increases translate into large aggregate payment increases. Aggregate payment increases reduce available capital for investment. Investment drives productivity. Productivity drives growth. Slowing productivity compounds slowdown. Liquidity tightening also affects international flows. Emerging markets often borrow in dominant reserve currencies. If the dominant currency strengthens during tightening, foreign borrowers face additional pressure. Debt becomes more expensive in local terms. Capital may flow back to stronger economies. Outflows pressure local currencies. Currency depreciation increases import costs. Higher import costs increase inflation. Inflation pressures central banks in those countries to raise rates. Raising rates further slows local growth. Global liquidity tightening transmits across borders. Financial globalization amplifies tightening effects. The most important shift during liquidity tightening is psychological. Confidence transitions from expansion to caution. Investors move from seeking yield to preserving capital. Lenders move from competing for deals to protecting balance sheets. Corporations move from growth to cost-cutting. Households move from spending to saving. These shifts reinforce contraction. The economy does not collapse in one move. It slows. Then slows further. Then fractures appear. Liquidity tightening is the hinge. If tightening pauses early enough, soft landings are possible. If tightening continues while leverage is high, stress accumulates. Accumulated stress triggers the next stage. Forced deleveraging. Forced deleveraging, when selling becomes survival. Liquidity tightening creates pressure. Forced deleveraging turns pressure into motion. Up until this point, stress builds quietly. Payments rise. Credit narrows. Investment slows. But balance sheets still hold. Institutions still function. Markets still trade. Forced deleveraging begins when cash flow can no longer cover obligations. When refinancing fails. When collateral declines below required thresholds. When lenders demand repayment. At that moment, selling is no longer optional. It becomes survival. Leverage works both ways. During expansion, leverage amplifies returns. During contraction, leverage amplifies losses. Consider a corporation that borrowed heavily during low-rate expansion. Its debt was manageable while revenue grew and refinancing was cheap. But now rates are higher. Revenue growth has slowed. Refinancing requires materially higher interest expense. If revenue cannot cover new payments, liquidity shrinks rapidly. The company must cut spending. Lay off employees. Sell assets. Issue equity at depressed prices. Each action weakens valuation. Weakening valuation reduces collateral. Reduced collateral limits borrowing capacity. Borrowing capacity contraction tightens further. Now consider financial institutions. Banks hold loan portfolios. Funds hold leveraged positions. Private credit vehicles hold illiquid debt. If asset prices decline while leverage remains high, equity cushions shrink. When equity shrinks too far, risk models trigger deleveraging. Margin calls accelerate the process. A hedge fund receives a margin call. It must post collateral. If it lacks cash, it sells assets. Asset sales depress prices. Depressed prices reduce valuations for others holding similar assets. Those holders face margin pressure. They sell. Selling spreads. This is the feedback loop. Forced deleveraging is mechanical. It is not emotional panic. It is contract enforcement. Debt agreements require maintenance of ratios. When ratios break, lenders act. Banks reduce credit lines. Investors withdraw funding. Covenants activate. The system shifts from expansion to defense. Defense reduces liquidity further. During deleveraging, asset correlations rise. In expansion, investors diversify. In contraction, investors sell what they can, not just what they want to. Liquidity preference dominates strategy. High-quality assets may be sold alongside risky ones simply to raise cash. Selling spreads across asset classes. Bond prices fall. Equities fall. Real estate valuations adjust. Commodity prices fluctuate. As asset values decline, household wealth declines. Wealth effects reverse. Spending contracts. Corporate earnings decline further. This reinforces balance sheet stress. Deleveraging is rarely uniform. It begins at the weakest points. Highly leveraged firms. Overexposed sectors. Speculative credit. Commercial real estate. Emerging markets with foreign currency debt. As weak nodes break, contagion risk increases. Lenders reassess counterparty exposure. Interbank lending tightens. Short-term funding market strain. Credit default swap spreads widen. Rising spreads signal perceived default risk. Perceived risk increases cost of borrowing. Higher borrowing cost increases actual default probability. The loop tightens. Central banks may attempt intervention. They can provide liquidity. But liquidity does not restore solvency. If borrowers are structurally overleveraged, liquidity only buys time. Time is valuable. It allows orderly restructuring. But if asset values continue falling, restructuring accelerates. Forced deleveraging affects governments as well. If tax revenue declines during slowdown while interest payments rise, deficits widen. Widening deficits require additional borrowing. Additional borrowing at higher rates increases fiscal pressure. Fiscal pressure can affect sovereign credit perception. If sovereign spreads widen, borrowing costs rise further. This dynamic is more common in emerging markets, but no country is immune to fiscal strain. Deleveraging also reshapes labor markets. Companies facing liquidity stress reduce payroll. Unemployment rises. Rising unemployment reduces consumer confidence. Reduced confidence decreases spending. Decreased spending reduces corporate revenue further. Revenue declines intensify deleveraging. The key insight is this: collapse does not begin with panic. It begins with arithmetic. Cash inflow less than cash outflow. Debt obligations greater than revenue. Asset values lower than liabilities. Once arithmetic turns negative, deleveraging becomes inevitable. Financial systems are built on leverage. Leverage increases efficiency in stable periods. But leverage reduces margin for error. The more leveraged the system, the less shock it can absorb. During forced deleveraging, volatility increases sharply. Volatility increases uncertainty. Uncertainty freezes investment. Frozen investment slows recovery. Slower recovery prolongs stress. At some point, confidence fractures. When participants believe asset prices will continue falling, behavior shifts. Buyers step back. Lenders retreat. Markets thin. Thin markets amplify price movement. Large price swings intensify fear. Fear accelerates selling. This is the acceleration phase. But even here, collapse is not inevitable. Policy response can slow deleveraging. Interest rates can be cut. Liquidity facilities expanded. Fiscal stimulus introduced. However, policy space may be constrained. If inflation remains elevated, rate cuts may be limited. If debt is already high, fiscal expansion may strain credibility. Constraints matter. The severity of deleveraging depends on how quickly leverage accumulated during expansion. The faster the expansion, the sharper the correction. The sharper the correction, the greater the risk of confidence fracture. Forced deleveraging is the pivot point. Before it, the system tightens. After it, the system either stabilizes or cascades. The final stage determines which. Confidence fracture. Confidence break, when the system turns on itself. Liquidity tightening creates pressure. Forced deleveraging creates motion. But collapse only becomes visible when confidence breaks. Confidence is intangible. Yet it underpins everything. Banks lend because they believe borrowers will repay. Investors buy because they believe markets will stabilize. Consumers spend because they believe income will continue. Governments borrow because they believe investors will finance deficits. Confidence allows leverage to function. When confidence fractures, the system shifts from expansion logic to preservation logic. Preservation logic changes behavior instantly. Depositors withdraw funds. Investors demand higher premiums. Lenders shorten maturities. Corporations conserve cash. Households increase savings. This collective shift amplifies contraction. A confidence break rarely begins with a single headline. It begins with doubt. Doubt about asset values. Doubt about solvency. Doubt about policy effectiveness. Doubt spreads quietly. Then suddenly. Consider the banking channel. Banks operate on fractional reserves. They rely on deposit stability. If depositors fear insolvency, withdrawals accelerate. Even healthy banks can struggle under rapid withdrawal pressure. Liquidity facilities exist to prevent this. But perception matters. If enough depositors doubt stability, liquidity strains. Confidence in banks is foundational. Now consider capital markets. If investors believe asset prices will continue falling, they delay purchases. Reduced demand lowers prices further. Lower prices validate fear. Fear reduces participation. Reduced participation increases volatility. Volatility signals instability. Instability reinforces caution. The cycle accelerates. Corporate decision-making changes rapidly during confidence breaks. Capital expenditure projects pause. Hiring freezes. Mergers stall. Inventory orders shrink. Economic activity contracts quickly when businesses prioritize survival. Households mirror this behavior. Large purchases are postponed. Credit card balances are reduced. Mortgage applications decline. Retail slows. This is not coordinated behavior. It is rational self-preservation. But collective rationality can produce systemic contraction. Confidence fractures also affect sovereign perception. If investors question a government's fiscal sustainability, bond yields rise. Rising yields increase debt service cost. Higher debt service reduces fiscal flexibility. Reduced flexibility increases perceived risk. Risk premiums rise further. Even advanced economies must manage perception carefully. Confidence break does not always lead to collapse. It leads to sharp contraction. Collapse occurs when contraction feeds into institutional failure. When multiple institutions fail simultaneously. When policy tools are insufficient. When trust in leadership erodes. But even severe crises rarely destroy entire economies. They restructure them. Banks consolidate. Weak firms disappear. Debt restructures. Regulations tighten. Growth resets from a lower base. The economy collapses in phases. Not into zero, but into contraction severe enough to reset leverage. The speed and depth of collapse depend on leverage level entering tightening, liquidity availability during stress, policy coordination, inflation constraints, global interconnection. If inflation is low, central banks can cut rates aggressively. If inflation is high, policy is constrained. If debt levels are manageable, fiscal stimulus is credible. If debt is elevated, stimulus risks bond market stress. Constraints shape outcome. Modern economies are more interconnected than ever. Interconnection spreads shocks faster. But it also spreads stabilization mechanisms faster. Central bank swap lines. International coordination. Emergency liquidity programs. These reduce probability of uncontrolled collapse. However, they increase long-term dependency on active management. This is the structural reality. Collapse is not random. It follows a mechanism. Overexpansion. Liquidity tightening. Forced deleveraging. Confidence fracture. Each stage feeds the next. Understanding the mechanism removes mystique. It does not remove risk. It clarifies it. Right now, many economies are navigating the tightening stage. Leverage remains elevated. Liquidity is tighter than in the past decade. Asset valuations remain sensitive. Confidence is cautious but intact. Whether collapse occurs depends on shock severity and policy response. Economic collapse is not destiny. It is conditional. Conditional on leverage. Conditional on liquidity. Conditional on confidence. The system turns on itself only when feedback loops outrun stabilizers. The question is not whether collapse is possible. It is whether margins for error are wide enough to absorb tightening without triggering acceleration. That margin is what policymakers are trying to protect. And that margin determines the next phase. Economic collapse does not begin with fire. It begins with imbalance. It moves through tightening. It accelerates through leverage. It spreads through confidence. And it ends in contraction. But contraction is not extinction. It is reset. Every major economic collapse in history followed a structure. Expansion built leverage. Leverage reduced margins for error. Liquidity tightened. Forced deleveraging began. Confidence fractured. Then the system either stabilized through policy intervention or restructured through recession. Understanding this removes the drama. It replaces fear with mechanism. The economy does not collapse because of one headline. It collapses when feedback loops outrun stabilizers. When debt exceeds capacity. When liquidity dries faster than policy can respond. When confidence evaporates faster than institutions can restore it. Right now, the global system is navigating tightening. Debt levels are elevated. Interest rates are higher. Liquidity is more selective. Confidence is cautious. Whether this becomes collapse depends on one variable. Margin. Margin for error in fiscal policy. Margin for error in monetary policy. Margin for error in balance sheets. If margins hold, the system slows but stabilizes. If margins thin too far, acceleration begins. In the next episode, we move from mechanism to inevitability. Because there is a deeper structural question behind all of this. Can the United States actually repay its national debt? Or is repayment no longer the goal? If the debt cannot be repaid in traditional terms, what does that mean for long-term stability? Because collapse is not just about markets. It is about sustainability. If you want to understand how debt, liquidity, leverage, and confidence connect beneath the headlines, subscribe. Not for panic. For structural clarity.